Good morning, everybody. This is not going to be an advertisement for the People's Trust other than obliquely. I was delighted to notice when I sat down that there is no feedback form on your seat. It's because I have a bit of a terror of feedback forms on speakers. It's the first time I ever had to speak in public was on the subject of pensions tax relief. And the organisers of the conference very unhelpfully sent me the verbatim comments that had been received from delegates. And I looked at the first one and it said at the bottom of the page, if I only had 20 minutes left to live, I'd want to spend it listening to Daniel Godfrey talking about pensions. And I thought, well, that's great, they love me. And then I saw he'd written PTO at the bottom of the page, so I turned it over and it then said, because then 20 minutes would seem like an eternity. So, not a great start to my public speaking career, but so I now make a point of not reading those verbatim comments. So, the subject of my talk today is, can investment save capitalism and will it? And the thesis behind this is really a proposition that capitalism has not been working as well as it used to. Not to say that it's ever been perfect, but certainly it seems to me, and I think it's pretty evident from the figures, that over the last 10 years since the global financial crisis, economic growth has not been shared throughout society. We haven't been providing the educational and advancement opportunities to as many people as we're getting it before to increase their wealth. And what we're seeing from that is increasing populism, increasing intolerance. We're seeing what I would describe as the electoral equivalent of the peasants storming the castle with pitchforks and torches because they want change, they want something different. It seems to me that many people, perhaps most working people, are feeling that they're having to run faster to stand still. And of course we're willing to make sacrifices if we believe we're building a better world for our children. But again, I think those people who are running faster to stand still don't believe that they're working harder to make that sacrifice. They see student loans, they see property prices, they see a slowing down of longevity, a slowing down of opportunity. And I think this is why there's so much dissatisfaction. Now, if there's one thing on which I think Jeremy Corbyn and Teresa May would actually sincerely agree, it's that we need to build a society that works for the many, not just the few. I don't have any doubt in their sincerity about that. But as someone who's been in investment management for a very long time, I'd say it seems quite obvious to me that the only way you can build a society that works for the many, not just the few, is to create more wealth and to share it more fairly. It's not going to work to just try to share a smaller cake more fairly. And what we've not been very good at doing is to create that bigger cake and share it more fairly. And I think the reason for that is an absence of productivity growth. It's productivity growth that drives the GDP growth, that drives tax revenues, that can be spent on education, infrastructure, and supporting healthcare. And why do we have this productivity crisis? It's been called a productivity puzzle. Well, again, not as an academic, but it seems pretty obvious to me that the only way you get productivity growth is through long-term investment and hard work. And that's where I think my thesis around investment comes in. So I'll make an assertion, and so please feel free if you violently disagree with it to put your hand up and have an argument. But I would say that the purpose of investment is sustainable wealth creation. That is why anyone would hand their capital over to another person. Because they need to create wealth that's not just here tomorrow, but that's here for their long-term future. And the output of sustainable wealth creation for the provider of capital is long-term, absolute returns, compounding beautifully over time in the way that Einstein is reputed to have described compound interest as the eighth wonder of the world, the most powerful force in the universe. But not only does successful, sustainable wealth creation deliver returns for investors that enable them to protect themselves from misfortune, to buy and to do the things they dream of buying and doing, and to look after themselves in a decent way as they get older. But it also has enormous impacts on economy and society, because by definition, sustainably creating wealth will lead to one or all of many desirable consequences. such as human capital development, innovation, better supply chains, protection of the environment, recognition that increasing pay inequality is unsustainable in the long run, recognition that not paying fair share of taxes will damage a company's license to do business in the long run. So it's enormously important in the context of improving companies, improving returns to investors, but also generating the productivity growth that comes from innovation, that comes from investing in people, that generates those tax revenues that can make the world a better place. So on that definition, I don't think there can be an activity in the economy which is more of a charger for desirable consequences than long-term investment. But if we look at the sausage machine of the investment industry, from where capital leaves investors' pockets or wallets or paychecks, to where it's being deployed by boards and chief executives in the economy, I think we see a chain of investment where the prizes are not given for sustainable wealth creation, but they're given for relatively short-term relative returns. And it should be no surprise that if our focus is on the short term, that comes at a cost to the long term, and is therefore depriving investors of optimised returns and depriving the economy of the growth it so badly needs. Now, I don't think this is because people working in that sausage machine are all entirely venal, just rubbing their hands at being able to rip off customers. I think we are locked into a loveless embrace where no one actually has the agency to change things. And it's one of the constant effects, I think, of human development and of capitalism, that it just gets faster and faster, time horizons get shorter and shorter. But unless we find some way of breaking this cycle, I think it's very difficult to see how we create a society that works for more people. So, having said that, can investment save capitalism? Absolutely yes, but I think we have to find a way to turn investment back to focus on the long term, focus on real businesses, focus on sustainable wealth creation. And where is the role of wealth tech in all of this? What is the role of the people in this room in helping to make this happen? Well, I think it's absolutely key and it's absolutely crucial. We have an industry, and David has been describing it just before I came up, where we have a natural focus on getting costs down. We have a natural focus because that industry has not, I think, dealt with scale in an optimised way. It's very hard to invest with high conviction in companies that create wealth sustainably. It's a very skilled activity. And if you're good at it, money comes in through the door. But I believe this skill is not that scalable. And I think the active industry's response to scale has been to move away from focus on absolute returns by investing in great companies and stewarding them well, to something which is in it almost infinitely scalable, which is controlling tracking error against an index benchmark. And because you can, whilst outperforming an index consistently is incredibly difficult, making sure you don't underperform it by very much every year is very, very easy. And I think it's led us to a point where the right answer to the question of the problems of active has been to buy passive, and hence the rise of passive funds, the rise of passive ETFs. Now, I do think we absolutely need to focus on cost. We need to give investors some of the benefits of the economies of scale in a way that the industry hasn't done. But what could be the role of tech in improving investors' lots? I was at a conference recently listening to a panel on psychology, on communication. And one of the things that kept coming through from the audience was everyone has different needs. And so we've got to think about the different needs of everyone, their attitudes to risk and so on. And I think that's only true to a very limited extent. Now, I need to have enough money to buy an Arsenal season ticket. You might need to have enough money to buy a Tottenham season ticket. People do have objectively different needs, but ultimately, if we all have long-term time horizons, our needs are all about having as much money in the pot at the end of the day in an optimised way. I don't think it's as complicated as we've made it in terms of trying to personalise. I also think we somewhat pander to the natural short-termism and risk aversion of human beings when it comes to financial affairs. Now, we treat people as being very monodimensional. We treat them as though we have to recognise that when the market falls 20%, as David said, they're going to phone us up and ask what's happening, and they're going to be upset, and maybe they'll leave us, and maybe that carries P&L risk and career risk for us. But actually, I think people are quite capable of understanding the proposition that if they've got 20 or 30 years to invest, they can either end up with a pot that's this big, but has some volatility along the way, or a pot that's down here and have no volatility. And which would they prefer? And I think the objective answer for nearly everyone is I'd rather have more money, particularly when they can see the historical impact of compounding means that that volatility is actually irrelevant to them over long periods of time. So I think the role for technology is in helping people get to better decisions which lead them to a better place. How do we use that? And I know that, I see Sean in the audience, I know that Nutmeg has been looking at online investor behaviour to see how they can preempt bad decisions that investors may be about to make, to try to help them get to a better place. I think that's what we should be doing in wealth tech, rather than just using big data to work out how we can sell more of the same old crap to people. I think we need to take a very different approach. We need to be focusing on their true objectives and on their true time horizons. But will we? I think that's the final point in this argument. Will the industry do this, or are we just too locked into this chain of investment where because it's everybody's fault, it's nobody's fault? Where because the chain of investment is so tightly bound, no individual link has the agency to change things all on their own. And I think that's where we need a roots-up revolution. I think we need to see the start-up businesses identifying the real needs of investors and focusing on how we can achieve those objectives. It's not all about cost, as David well knows. It's not all about can we get it down from 8 basis points to 6 basis points to 5 to 4. Now, if we are investing in truly great businesses and supporting their long-term development, then actually the difference between 20 basis points and 60 basis points of cost over 10 years is going to be the tiniest part of any differential in performance. The stock selection, the value add that investors can give in saying to boards and chief executives, we want you to stop buying back shares so that you increase earnings per share and generate your maxing out on your LTIP schemes. We want you to stop chopping down the trees in the orchard because the value of the wood is worth more than the value of this year's apple harvest. We actually want more apples in 10 years' time, and we want you to plant more trees. To be honest with you, I think it's pretty much touch and go as to whether the industry will play this role. I mean, whether it will play a positive role in helping to create the growth that can get us to a better place. But we certainly have the potential to do it. And I believe that it's absolutely vital that we do everything we can to provide to our investors the best possible outcomes over long periods of time and to play our role in supporting companies to create growth in the economy. It's not just about investing in pieces of paper, we're investing in real businesses. So investment and stewardship, I think, are key. Thank you very much.
Are there any questions? You've got a couple of minutes. I'm sure Daniel's happy to answer any questions you've got. I'll kick it off, Daniel. If the industry doesn't rise to the challenge, what do you think will happen to investment? Because investment will go on, but what do you think the net effect of it will be?
Well, I think the net effect is individuals not achieving the goals that they need to achieve because the compound returns they're getting are not as good as they need to be. And I think it would be a continuation of winner takes all, where most of the wealth that's created in the investment chain is being captured by capital market participants, so people working in the industry, getting quite rich, and where other than people who have either high levels of capital that they've inherited or are lucky enough to get into the jobs that pay very high incomes, people are very dissatisfied. And I think that would lead to a continuation of the sort of intolerance and populism that we've been seeing in the last few years.
Do you know, I mean, there is a thesis out there, which even I think is probably realistic, which is that the government will step in. We've already seen this in Chile, where there are national mandated retirement schemes. It's even been talked about in America, which has gone a long way down the road towards a voluntary provision of retirement. There have been mutterings about that the state must intervene. It doesn't require an enormous leap of imagination with Nest auto-enrolment for the government to effectively say, well, you know what, because you, the private industry, can't cope with long-term wealth accumulation. We're going to basically set up a national scheme. We'll bring a few managers in to work for us, the Chilean model, and let's just forget the market solution.
Sure. So I think good news, bad news. There could be a case for saying that if people don't save enough, there needs to be intervention, because otherwise we end up going bust as an economy. But will that lead to sustainable wealth creation? So I'll give you an example of the sort of conversation. One of the conversations I've had in this project with the People's Trust was talking to the head of equities at one of the Australian super funds.
Superannuation funds.
So where they've got a mandatory contribution to pension schemes. So hugely long-term time horizons for these schemes. We talked about what I was trying to do at the People's Trust, the idea of it being not fund of funds, but multi-manager with separate portfolios, where the managers, unlike in their funds, have been given by our 7-year contracts to match the 7-year time horizon of our absolute return objective. And he was saying, look, this absolutely makes sense. I've got no doubt it's a better way, objectively, of investing, that we find these companies, we back them, we stick with them. Clearly, we'll make mistakes and we have to change some of them. But overall, we think we'll help those companies perform better and we should get better long-term returns. But there's no way I would invest in something like this. And the reason I wouldn't invest in something like this is if I invest in a fund like this and you're behind the index after 3 months, my boss is going to be sending me an email saying, why have you bought this shit? And so here's someone with a time horizon in the fund, objectively, and it's an asset owner, not an asset manager. This is not a commercial organisation in that sort of way, who's still got the equivalent of P&L risk and career risk on very short-term time horizons. So I think the problem is as much cultural, philosophical as it is structural with the in terms of government and savings. But I wouldn't rule out the need for government to take some action, or it actually taking some action. But whether it'll work or not is another matter.
Question. I've got one question, but any other questions? Gentleman over there.
There seems to be a problem with public markets.
Yes.
The private equity industry doesn't seem to have as much of a problem with this.
Yeah. Well, I think you're right. Obviously, public markets are very big and generate creating a lot of the big component of GDP. I think many of the elements of the way private equity works with investing companies actually is what I'm talking about in terms of public market equity. I think you also have other problems with public markets, such as listed companies don't really need equity capital. It's very easy to get debt capital, and so on. And I think where that ultimately leads today is to say that if you're going to invest in public market equity, you need to be very fussy if you want to optimise, because there are not many companies that will generate the sort of compounding returns that you're looking for in a world where they're not so dependent on shareholders, where they can just get money from the banks and sort of zombie on for a long period of time. And I think that is a question we should be asking about: do we want to invest in every company in the index?
Any other questions? Just one from Daniel.
Daniel, how genuine would you say the threat from wealth tech and startup wealth managers is for traditional wealth managers that are established? It's still a very small part of the market.
Yes.
How big is that threat?
Well, one of the things that occurred to me when David was speaking was, when you mentioned service, was, who are the most loved company in the UK for service in wealth? St James's Place, probably. Yeah, by their customers.
I maybe struggle with the word loved, but
so much of the research shows the customers.
They're a very successful brand.
They may not be loved by a lot of people in the industry, but they are loved by their customers.
Yes.
So that, I think, makes it quite difficult, because there's no doubt that cost pound per pound, there's a big gap, but they are loved for service. So I do think that ultimately tech will disrupt. The question that I think is, I can't answer, is whether incumbents will acquire their way to success, or whether they will get disrupted out by startups that make it all the way to the finish line. And you'll probably, if you see my bio, you'll see that I sit on the board of not a wealth management firm, but a fintech startup. Obviously, the best scenario is that you continue independently, that you become a very big player, and you reap the rewards of that. You become the next Hargreaves Lansdown. I'm sure nothing would keep have that in their sights. But of course, not every startup's going to get there. Some of them will get acquired along the way. Will they be acquired by existing incumbents that go on to be the winners? I don't know. That's not my area of expertise.
I've got one very last question, unless somebody else has got one.
How important do you think open banking is in changing the industry with regards to the customer?
Well, I think, I don't know about the industry as a whole. I know for Moneybox, we can't wait for open banking because it'll bring our costs down, make what we're trying to do an awful lot easier. I think it has a big role to play actually in making fintech work better. Yeah. I've stopped holding my breath though.
One very last question for you, Dan, from me. You like I am involved with active investment trusts, and things always been curious is that all the Robo platforms and all the other digital wealth platforms are using, I think with one exception I could think of, are using ETFs. Why doesn't somebody, do you think I don't understand this, why isn't somebody launching an active solution?
Okay, well when I was setting up the People's Trust, I wrestled with it.
Yeah.
Certainly one option would have been to say, we're going to be very disruptive, we're going to be very, very low cost.
Yeah, exactly.
I'll pay one person to do asset allocation, and we'll have a portfolio of ETFs. But I think it comes down, so you get my prejudices here, this comes down to comparisons with active. And the key active model doesn't work. Yeah, so the mainstream active model, trying to control tracking error against a benchmark means that the vast majority of funds inevitably, over long periods of time, will underperform the benchmark, and therefore the obvious answer when you look at the majority of index funds is, well, I could be much lower cost and I'll probably do better, so let's be in passive. So I absolutely understand why if you're trying to disrupt that majority model, you'd say, well, we'll bring down costs through technology and we'll bring down costs in the investment management space. You see since retail distribution review, now that investment advisors can write their own checks effectively, that becomes much easier for them to sell low-cost ETFs or index funds and increase the amount they charge for the client, and the total cost for the client doesn't change. So when you talk about 3% not changing, in a sense, it doesn't change even if you use ETFs because someone else just takes that margin. It doesn't seem to get back to the client. So I think a direct relationship between wealth tech and the individual consumer is how that cost gets taken out. And I'm sure that's where
my only question, why couldn't you just build that into your model, effectively just get the very best active manager and stick him in a Robo platform?
Well, I wanted to create a one-stop shop rather than, here's a choice of 5, because I think what I get through my one-stop shop is I get diversification without giving up conviction. And so it's, obviously people with more money can choose their own things. I can give people bespoke versions, higher conviction versions of what outstanding asset managers do in one package that's not trying to outperform an index. I mean, if you ask me over 7 years, do you think you'll outperform the global index? The answer is hell yeah. But that's a consequence of the way these people run money, not the objective. And I think that's a vital point to bear in mind, that the harder you try to beat an index, probably the more difficult it becomes.
Well, very quick question, Peter.
You've always been ahead of the curve, sort of championing the consumer in your role in the AOC. And you mentioned just now that the wealthier can have more access. I think one of the challenges of the industry is 1%. They pay less, they're smarter, they do the Vanguard ETFs, but they also access alternatives. Do you think wealth tech, in addition to stopping the mass market being oversold closet index trackers, can it play a role in an asset allocation that actually takes people into areas like private equity,
exactly.
commodities, etc., that generates alpha?
It can do. I mean, I think you need to think about how you do it in a way that's safe. And so again, I'd say that because most people just need to end up with as much money in the pot as possible in a long period of time, in a sort of risk optimised way. And I think that something that we said in our prospectus that we would want to do as we grow is to expand out of the public market equity space and into alternatives, so that every investor, whether they're putting in £1 million or £6 a week or £1 a time, would be getting a default exposure to some private equity, some property development, some infrastructure, as well as public market equity. So from my perspective, thinking about every man and every woman and giving them a core investment vehicle, I think absolutely yes, they should have some exposure to it, but I think it's as part of a single package, so you can just file and forget.
Okay, well, thank you very much, Daniel.
Thanks.
Very grateful. Thank you for coming on. The offer for a subscription is still open until next Wednesday, so you've still got time to get in there for People's Trust.